Powell, I think that he wants to leave his job as Paul Volcker and not an Arthur Burns. Um, Burns, which in the 70s, he actually preemptively cut rates, as Trump is requesting now. But he's probably considered one of the worst Fed chairmen ever. And I think Powell wants to hold in the face of higher inflation, despite expectations of weaker growth, and he wants to Trump and the market and basically the public to understand that he's going to go Volcker and he's not going to cut rates despite of weakening economy and this new added pressure from President Trump that and I mean I said before it's just nothing new, but there's been rumors as well that Trump is kind of laying the ground to use Powell as a scapegoat if the economy actually derails.
This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance.
Hello and welcome back to Converge Market Update. It's April the 22nd. It's the first day back from the long bank holiday weekend. And in today's episode, we're going to be diving into the Sell America trade, and that's gathered momentum over the last week or so, particularly over the last few days on the growing concerns around President Donald Trump's threats to fire Federal Reserve Chairman Jerome Powell. So we've got Kevin Ford again joining us today, our FX and macro strategist based in Toronto, Canada. And we're going to be unpacking this latest story that's shaking markets and rattling investors worldwide. Kevin, great to have you back on. It's been a wild journey so far this year, to say the least, and the US administration's actions continue to amplify economic and policy uncertainty. Obviously, this is continuing to create a challenging environment for not just market participants and policymakers, but businesses and consumers alike. And this latest story, we've got Trump ramping up the pressure on Powell again. What's your take on Trump threatening to sack Jerome Powell?
Hey, George, thanks for having me again. I think that this seems to reflect how Liberation Day is playing out for President Trump. The reality is that people are losing confidence in his policies. And we know Trump put inside, as some people have asked for Trump to kind of come to the rescue. He's now calling for a Fed put. But, like Fed chairman has made it clear that their priority is to ensure that tariff impact remains like a one-time effect on prices and nothing more. This is also a reminiscence of what happened in 2019. I don't know if you recall back then, but Trump pressured Powell to cut rates, and he was again vocal about his dissatisfaction with Fed's policy. This is nothing new, what we're seeing, and he went so far to call him an enemy at some point, but Powell might maintain that the decisions that were based on economic indicators back then. Some would say that the decisions to cut rates, there were three actually in 2019, were influenced by Trump's criticism, but he maintained that the decisions were purely based on hard data. And I think that this time might be a little bit different. Powell, I think that he wants to leave his job as a Paul Volcker and not an Arthur Burns. Burns, which in the 70s, he actually preemptively cut rates, as Trump is requesting now. But he's probably considered one of the worst Fed chairmen ever. And I think Powell wants to hold in the face of higher inflation, despite expectations of weaker growth, and he wants to Trump and the market and basically the public to understand that he's going to go Volcker and he's not going to cut rates despite of weakening economy and these new added pressure from President Trump that and I mean I said before it's just nothing new, but there's been rumors as well that Trump is kind of laying the ground to use Powell as a scapegoat if the economy actually derails. Do you think uh, that's what that's the Trump's agenda behind all of this, and that if there's the confirmation of an economic recession in the U.S., do you think that uh, like Trump will point fingers to Jerome Powell?
To be honest, Kevin, I think he's already using him as a scapegoat. He's suggesting that even though the Fed's made those 3 consecutive rate cuts last year, the pause that we're in at the moment, the holding rates as they are for the time being, is ramping up recession risks. Trump is not admitting that it's anything to do with the volatile decision making from his administration, the flip flopping on tariffs. We've seen policy uncertainty soar to record high levels. Business consumer confidence is tumbling. Investment decisions are being halted. Some inflation expectations are on the rise. And all of that has really stemmed from Trump's Liberation Day, as we know. And Trump is saying, it's nothing to do with that. It's because Powell hasn't continued lowering interest rates that we're in this state of flux and the rising recession risk. So I think Trump's already attempting to deflect responsibility, and by targeting Powell, obviously, if we do have a recession further down the line, he can frame that it's the Fed's policies that have been the root cause of this downturn, rather than his own trade policies or fiscal decisions. But it's nothing new, like you said. Trump against Powell back in his first term, he was pressuring Powell to lower rates even when rates were low, and now in this era, the macro conditions are different, like you said, but the pressure on Powell is the same. It's just the latest chapter in this long-running beef between the two. But obviously, it brings with it this additional risk of the Fed losing its independence, which is the chatter in the media at the moment.
Yeah, and why do you think it's important to remind people of the Fed's independence? Like, why is it so important right now?
Yeah, good question. I think, firstly, it allows the central bank to pursue its dual mandate, which is maximum employment and stable prices. That's without the unnecessary political pressure. So this independence is going to help ensure that the monetary policy decisions made by the Fed is solely based on economic conditions and long-term stability, rather than short-term political gains. So, number one, it prevents political interference. Number two, it builds credibility. An independent Fed is vital for preserving trust in US monetary governance and avoiding economic turmoil. Public financial markets are going to trust the Fed more because they know it's not subject to short-term political impulses. Imagine if the president could manipulate interest rates, it's going to spark way more confusion. It's going to erode confidence in the US economy. It's probably going to lead to inflation spikes and therefore long-term interest rates moving higher as well, meaning higher borrowing costs, of course. And it's exactly the opposite of what Trump is trying to achieve. And then obviously the third point, which is really why we're talking about it, because of the implications we're seeing in the market, is the fact that if the Fed does lose its independence, it could undermine the faith in the US amongst global investors as a destination for their capital. It could damage America's reputation as a financial anchor. And I think that's been reflected in what we're seeing across financial markets in reaction to this spat between Trump and Powell. And it's just another reason why we're seeing the dollar being sold off. and this acceleration lower that we've witnessed over the last few days or so. The dollar falling to a 3-year low just recently. I mean, what do you make of the continued decline of US assets, Kevin? I mean, equities, but predominantly what we're seeing in the US dollar, the weakness in the dollar over such a short space of time. What are your thoughts?
Yeah, it's yesterday we saw another breaking of traditional correlations. Equities down, US dollar down, yields up, and these trifecta in the markets. It's unusual, and it's definitely affecting asset managers, investors, particularly in North America. And I think that this is clearly sending a message that, I mean, what's happening now, people are rotating out of US and particularly to gold. I guess, of course, you've seen what's happened with gold's price recently hitting a new all-time high, closer to the 3,500, if I'm getting the number correctly. But so yeah, when we saw what we saw, for example, in the great financial crisis in 2007, or the COVID-19 shutdown, when there were major equities sell-offs, and we saw the US dollar gaining strength because of, like the greenbacks appeal as, like a safe haven, right? But
Yeah.
the correlation has turned has shifted from negative to like slightly positive, and I'd say that this is not just, of course, because of what we've seen between Trump and Powell, but also these trade war against all trade partners, and the retaliation that has come from a few U.S. Fiscal policy expectations, as well, having shifted to a more contractionary direction. And in general, the policy making and the implementation, the communication, this is already hurting confidence in U.S. growth. And if anything, April 2nd has made it worse. So this is something that definitely is keeping the markets on edge. But also, it's important to note, and I guess it's something I wanted to kind of like discuss and ask you about a little bit. It's that President Trump has also mentioned that he wanted a weaker dollar, and he's always wanted a weaker dollar to balance trade deficits, right?
Yeah.
And there's been mentions about the Mar-a-Lago Accord. I don't know if you've read about this paper that was written by Stephen Miran last year. He's actually part of his economic cabinet now, but it seems that what we're seeing now, it's aligning with the paper, or the proposal, or the primary objectives of the accord, to like introduce tariffs and strategically weaken the dollar. And so how do you see this playing out for the U.S. administration, and as well, and the spillover effects, not just in markets but in the economy as well?
Yeah, I think you're right. I think short of this Mar-a-Lago Accord being put in place, we're already seeing what the Trump administration actually wanted to unfold, even if it wasn't directly in the way in which they touted originally. But I think it's, as you explained, this whole weaker dollar is what is Trump sees as like the main reason for the falling share of US industrial jobs. So a stronger dollar is not what it needs, and this weaker dollar is probably it's good news for the Trump administration and what it's trying to achieve here. And I think just in light of that, we can't discount a continuation of dollar weakness unless something in financial markets breaks, and you see a real surge in demand for the US dollar for liquidity reasons. But at the moment, it just seems like, as you say, there's a breakdown in traditional correlations between the dollar and yields. And it's kind of reflecting this heightened doubts about the safety of US assets in periods of economic stress. But, I don't think it's really bothering the Trump administration, do you? I think that this is exactly what they wanted to play out. And, it's probably going to continue unless something breaks in the financial system. Would you agree with that?
Yeah, definitely. And I guess the questions that markets have been and investor participants have been asking recently are more of existential questions around dollar, right? Like, and there's been, lengthy debates around how could a weaker dollar undermine its global reserve status, and how the accord is actually proposing devaluing the US dollar to boost exports while maintaining its status as the world's reserve currency. I'd say that short term, of course, when you look at charts and markets reactions and how people are feeling around markets, there's a lot of fear and uncertainty, and of course these questions come to the spotlight and make you think: are we not just deglobalizing but also de-dollarizing our markets, and investors staying away from dollar for the long term? And it's I guess it's important to ask the question, but I'd say that headlines, of course, and sentiment might increase, of course, the sentiment around it, and just make it a little bit overstretched. And I'm not sure if you agree with it, but maybe we'll see in the next few days if there's some headlines coming our way in relation to the U.S. Signing trade agreements, or starting to sign, just basically start to negotiate with major trading partners, and this would help a little bit to ease off fears around trade policy and what has been unleashed a couple of weeks ago with Liberation Day.
Yeah, exactly. I think, like I said earlier, I think the Trump administration's not going to be disheartened with a weaker dollar. That's what they want. But at the same time, if we do see some of these trade deals make some positive movements, it's probably going to support the dollar in this particular time where the consensus trade is for continuation of a weaker dollar. It's often prudent to be on the contrarian side of things, right? If everyone's betting against the dollar, then, we saw the economists saying it was the end of the dollar. Sometimes that is a sign of a reversal on the horizon. But we'll see. Plenty to digest, lots going on. But I think this particular story about the dollar maintaining this weakness, or this weak trend, is something that we're going to be talking about a lot more in the future. So we'll leave it there for today, but we'll certainly be back in a couple of weeks' time to see what's unfolded. Thanks, Kevin, as usual, for the brilliant insight. And thanks to all our listeners for listening. Don't forget to subscribe for your regular dose of market insights. Cheers all. Thanks, Kevin.
Thanks, G.